Okay, hello everybody, and welcome to Law 2025 Online, Wills and Probate Shape the Debate with me, Professor Leslie King, and Parisa Jones. The session's due to last 1 hour, and we'll be dealing with various pre-submitted questions that we've had. If you didn't get a chance to submit your questions ahead of the session, don't forget to sign up to the Solicitors Group emails, which will alert you to forthcoming Wills and Probate Shape the Debate sessions, as well as giving you some professionally curated updates to support you in practice. The session's sponsored by Watchman Insurance, and I've certainly listened to lots of presentations from Watchman Insurance, but we have got some information which we can read to you to make sure we don't miss anything out. So, Parisa, do you want to read out the Watchman stuff?
Absolutely. Watchman is a specialist insurance policy only available to solicitors. It provides insurance for unoccupied properties and has been revolutionary in changing the way probate solicitors protect their clients' estates by reducing initial pressure on your funds whilst you are still trying to access the estate and sell the property. Watchman achieves this as solicitors do not have to pay a full upfront premium. Cover is secured by simply paying a small deposit and continues with a daily premium charge that is deferred until the property is sold or transferred for up to a year. No finance agreements and no cancellation charges. It is also available for homes where clients are in care or with reduced legal capacity. Getting you started and arranging cover is easy. If you would like to learn more about Watchman, you can contact their helpful team on 01935 389 812 or via their emailing, which is inquiries@watchmanservices.co.uk.
Okay, thank you, Parisa. Well, as I've already said, I'm Leslie King and I lecture on wills, probate and tax matters quite a lot. For the Solicitors Group this year, I did 2 sessions, one on they're not exactly forthcoming, but they're heavily trailed changes to business property and agricultural property relief, which I imagine many people have had their phones hanging off with worried clients phoning up. So that was one. And the other one that I did was powers in wills and trusts, which was largely based on the STEP standard provisions, the new 3rd edition. Parisa, I'll let you introduce yourself and say what you've covered this year.
So I'm Parisa Jones. I'm a solicitor and partner at Leicester Aldridge. I'm a qualified trust and estate practitioner, and I'm also an accredited member of Association of Lifetime Lawyers. I prepared 2 sessions as well. One on estate planning, how to prepare effectively structure tax planning reports. It's one of the most important things as private client solicitors we can do, preparing reports for our clients. And it's so important that the advice is clear, easy to understand, and we don't leave any scope for any ambiguity, misunderstanding, or challenges being made. And my second session was on nil rate band discretionary trusts, where we started, what's happened over the last 20 odd years, where we are now, advice to give clients, and what to do with the neglected nil rate band discretionary trusts that I'm sure we've all seen. If you haven't already, you can still purchase the full Law Online pack today, and that will give you full access to the sessions and the topics which we'll be discussing today.
Okay, I have to say, I do just echo that last bit about the neglected nil rate band discretionary trust. I think that's probably one of the questions I get the most often. This has just landed on my desk when the second spouse dies. Nothing whatever has happened. I will be amazed if we don't have a question on that coming up.
Yeah.
So we do have a fair number of questions to get through. If I take the first one, which is unsurprisingly about the projected changes to business and agricultural property relief, I'm sure you don't need me to remind you, but the promise is that 100% relief will be limited to £1 million worth of combined business and agricultural property. And after that, any additional property will only qualify for 50% relief. So my first question is, how does it work if someone dies with a qualifying interest in possession in a trust, which has property eligible for 100% relief, and also property eligible for 100% relief in their free estate? And that one is quite easy to answer, actually, because it's very similar to the way in which the nil rate band is apportioned at the moment. So if you think about the principles of having a qualifying interest in possession, the person with that interest is treated as owning the underlying trust property. So basically, if they have property eligible for 100% relief in their free estate, property eligible for 100% relief in the trust, what you will do is you will see how much the property comes to. Let's say it comes to 1.5 million. So you have exceeded the £1 million cap on the 100% relief. You will then simply apportion that cap between the free estate and the property in the trust. And so if the property eligible for relief in the free estate was twice as much as the property in the trust, then you would get, can I do the arithmetic here? I think you'd get 2/3 of the cap attributable to the free estate and the rest attributable to the qualifying interest in possession trust. So, as I said, it's an apportionment and it works in exactly the same way that you'd be apportioning the nil rate band. So that was a relatively easy one to answer. Parisa, what about one of yours?
So I've had a question come in. I'm dealing with an estate where mum has died and dad is now in a care home. The executors are the children, and they want to know whether the children can bring the nil rate band discretionary trust to an end in their favour. And I actually have a situation fairly similar that I've dealt with recently. Mum has died, dad is in a care home, dad is a self-funder, and his money is going down quickly because care homes are expensive. The children are often concerned about their inheritance going on care fees and what's going to be left for them at the end of the day. And they do ask that question, well, dad's in a care home, he doesn't need it, can we have it? But the answer isn't a straightforward answer. The starting point is normally, well, what's in the memorandum of wishes? What did mum actually want? Because if the will was drafted well, you would hope that it is something that the solicitor had discussed with them at the time. How do you want the money to be used? What are your views if your surviving spouse goes into a care home? Who would you want to benefit under those circumstances? And particularly with a lot of the pre-2007 wills that I've seen, they do say that they want the surviving spouse to be considered the primary beneficiary and to benefit over and above any needs of any children or anyone else. And that's something that as executors and trustees, you can't just disregard. You do have to have some regard to it. But you can also appreciate where they're coming from, that perhaps if, mum or dad had updated the will, they might not necessarily want the money to go in care fees. So the discussion I have with my clients is actually, what is the surviving parent's situation? What funds do they have? Is the money being invested perhaps as well as it could do? Do they need to get some financial advice to make that stretch a little further? Is there perhaps some in-between option where they could point some funds out of the trust for the benefit of themselves, but not completely depriving the living parent? It's not always what the children want to hear. And I've had a situation in the past where the children didn't like that advice and I think went elsewhere to get what they wanted. But I think as solicitors, we do need to be exercising a little bit of caution in these situations, because ultimately, if the situation, dad runs out of money, he's looking for local authority funding, questions are going to get asked. And I think the trustees would leave themselves vulnerable to a challenge being made if they felt as though that they hadn't exercised their discretion in the correct manner without taking all matters into consideration.
You can tell from my face that I'm going, on that one. I mean, the first thing that you would do is to have a look at what the trust instrument says, who the beneficiaries are, and then absolutely right, you then look at the letter of wishes. Um, and you are absolutely 100% right that the trustees would be open to criticism if they didn't take everything into consideration, including the letter of wishes. But it is important to remember that it is a letter of wishes and it is a discretionary trust, and the trustees have been appointed to exercise discretionary powers. And I suppose the one thing that I would say is that I think a local authority would find it very difficult to challenge a trustee's appointment to beneficiaries, bona fide beneficiaries of a discretionary trust, um, on the basis that they had not complied with the letter of wishes, because the letter of wishes isn't binding, but it is obviously of strong persuasive power. So I'm not disagreeing. I'm just saying, well, yeah, but you do have to sort of weigh
I
up those things.
Absolutely. I think it is a complete balancing act, and it's not always a yes, you can do it and no, you can't. It's actually understanding the circumstances. So if dad was in a care home, but he actually qualified for continuing healthcare and funding wasn't an issue, it's a little bit easier to say, well, actually, he's not going to
Absolutely.
need it. It might be that he has a fairly limited life expectancy, where again, you could take the view, well, he's probably not going to need it. He might have £1 million sat in the bank after selling a property. Chances are he's not going to need it. It's always really difficult. And quite often you look at, well, who would say something if things go wrong? You know, is there someone else in the background that will say, well, dad should have had some money? Are they going to kick up a fuss? And like you said with the local authority, it might be hard for them to make a challenge, but it doesn't mean that's going to necessarily stop them or stop someone else from interjecting and saying, well, that was wrong. You didn't exercise your discretion, taking all relevant matters into consideration. And I think you have to look at it on a case by case basis, and understand what the bigger picture is and go from there. And a discussion I have with some of my clients is, well, we've got 2 years to decide what to do about the nil rate ban discretionary trust. I think we've probably all had situations where one spouse dies, and then it's only a few months later that the other spouse dies. And although it's an awful situation to be in, but the problem to a certain extent resolves itself. We don't need to panic. We don't need to worry. We've got time to make that decision.
And of course, you can make that decision outside the 2 year period. It's just that you won't get the reading back to the date of the
Absolutely.
first death. But yeah, I mean, it is surprising how often you do get deaths in quick succession. But okay, I think we've probably done that one. Should we go to one of mine, which again is business property relief? What if someone had, before budget day, established one or more trusts containing property eligible for 100% relief, and then after budget day, they establish additional trusts containing property eligible for 100% relief? Well, anybody who set up a trust before budget day is probably feeling pretty smug at the moment, because you get the benefit of the new rule, of the old rules. So your transfer in was eligible for 100% relief, and each trust will have its own £1 million limit. If you set up trusts now, so after budget day, even though we haven't yet reached the date when the new trusts come in, we are in what you call the transitional period, and there are special transitional rules that apply. And any trust that you establish now, you would get the £1 million um, allowance on your 100% relief. But if you establish several trusts, that £1 million allowance is going to be split between all the trusts that you create on or after budget day. And the £1 million allowance for 100% relief is applied chronologically. So if I put £1 million of eligible property into a trust today, that uses up the whole of my 100% allowance. And if I put another £1 million in tomorrow, that is only going to benefit from 50% relief because I have completely used up my £1 million allowance. And going forward, this I think is quite, one thing I should say, of course, is that what I'm talking about is what was in the consultation paper on how it's going to work in relation to trusts. It is only a consultation paper, which means that theoretically, what the suggestions are might change. I wouldn't put much money on any serious change, but these are only proposals. But the proposal is that if you create trusts after budget day, you will have to split that £1 million cap on 100% relief. It will be applied chronologically. And the proposal is that it will be fixed. So once you've used up the whole £1 million worth of 100% relief on your first couple of trusts, those trusts might be wound up in the next few years, but you can't recover that £1 million allowance. It's gone, it's used up, and your later trusts are only going to be eligible for 50% relief. And so, as I said, anybody who created a trust before budget day, each of those trusts created has its own £1 million allowance for the 100% relief. And as I said, those people are going to be feeling pretty smug. Do you have anything to add to that, Parisa?
I think it just highlights the importance of clients getting advice about the impact on it and actually looking at the bigger picture. Because I think we often have clients that will come in because there's a situation perhaps going on with one of their children. They want to address that. They say, I'll deal with the rest of my children separately. But actually, if what they're going to be doing with the first child is going to impact the other children further down the line, then actually we need to be asking those questions. What's the plan? What are you looking to achieve in the long run? Because you certainly don't want to prejudice any other family members from action that they've taken, perhaps rather innocently, just to solve a problem that they're addressing at that time.
There's one, I don't think this comes up in a question actually, but I will just mention it because it was triggered by something that you said about successive children. There's quite an interesting proposal in the consultation paper in relation to trusts for bereaved young people, where you might set up one of these trusts for, let's say, your 3 children, contingent on reaching age 25. And if that trust is holding property which is eligible for relief, as the property exits the trust, the normal rule is that you will be using up your £1 million allowance. But for Trust for Bereaved Young People, it's rather generous. And the proposal is that each young person will have their own effectively £1 million allowance, which, could be quite generous. And that was about the only thing that made me even mildly happy as I read through the consultation paper. I thought, oh, well, that is actually quite generous. But the idea was that the older siblings shouldn't benefit and the younger siblings shouldn't be prejudiced by the fact that there is now an allowance on 100% relief. Okay, do you want to do one, Parisa?
Yes, I've got another question. Also about nil rate band discretionary trusts. Is there still any value in including nil rate band discretionary trusts in wills, or are they now obsolete? And you hear a lot about people saying that they are completely irrelevant now, but actually I think more than ever, I'm including them in drafting wills. It's not just about the availability of the transferable nil rate band. It's again looking at the bigger picture. And this is often a common theme with what I talk about, but you have to understand your clients, their position, what they're trying to achieve in order to advise them as to what's best. It might be that they have another nil rate ban from a predeceased spouse. And if you've got a married couple that both have predeceased spouse, there's the possibility of claiming four nil rate bans. So you need the nil rate ban discretionary trust in order to capture it on the first death. It might be that the couple are unmarried and there is no transferable nil rate band. And to maximize efficiency from a tax perspective, including the nil rate band discretionary trust is a really good way to proceed. There might be other reasons, such as asset protection, having an element of control, or conversely, an element of flexibility. There's lots of reasons as to why they are really valuable, um, even beyond just the being able to claim the residence nil rate band. But you need to understand your client's position, what's going on, in order to assess whether it's worthwhile or not. I had some clients come to me recently. They'd been referred to a will writing company who just sold them a package, and they sent me the leaflet, and they included nil rate band discretionary trusts and then everything else onto a flexible life interest trust for spouse and then a discretionary trust. And the client said, well, what do you think? So we had a meeting, but actually in that situation, there was no need to have the nil rate band discretionary trusts. Their estates were worth about 16 million. There was no other circumstances which justified the additional cost. But then I have other situations where actually it's a really valuable step to take to include that trust in the will. But it's a matter of understanding what their position and not just selling generic advice.
Yeah, I mean, I think from an asset protection point of view, it's a good thing to have. Although obviously, if you're having a flexible life interest trust as well, you've got the asset protection. Um, I do think married couples need to think about asset protection. The number of very late second marriages that take place, and the children are horrified because they severely doubt that the parent has actually got capacity.
Yeah.
But your chances of actually getting a marriage prevented or set aside on the basis of lack of capacity are really quite slim. So asset protection, I think, is a big big matter. And also just keeping the estate of the surviving spouse low. It doesn't make a huge difference if you've got wealthy clients, but nil rate band discretionary trust, you are keeping those assets out of the estate. And if you compare the amount of tax that gets paid when the surviving spouse dies on their free estate with the amount of tax that you would be paying on a nil rate band discretionary trust, it usually works out very considerably in favour of the nil rate band discretionary trust. So, yeah, I think for many people, it is definitely a useful thing to have.
Yeah, I think it's definitely something that we should be exploring with all of our clients, even if it's an option that gets discounted. We do need to be thinking, is there merit? Is there an advantage? And quite often with these things, that what I say to the clients is, worst case scenario, you pay for a slightly more expensive will. Sorry, I've not moved, so the lights have gone off. You pay to have it wound up within 2 years. The worst that you're dealing with is the costs. But actually, in a lot of situations and with a lot of family setups and dynamics, there are other reasons as to why that trust is beneficial, just going beyond the surviving spouse.
Absolutely. Okay, I've got a very short question here, which is when does the 50% rate come into effect for shares quoted on the alternative investment market? I probably ought to give a little bit of background to this. For quite a considerable length of time now, we have had companies which have been pushing investing in shares which are quoted on the alternative investment market for the sake of the business property relief that you could get. Octopus Investments is probably the best known. I've certainly also listened to presentations from Investec, who were also pushing these investments. And for elderly people who were worried about inheritance tax, shares quoted on the alternative investment market were a very good option, because once you've owned property for 2 years, you become eligible for business property relief. And as people always said, the alternative, if people are worrying about inheritance tax and minimizing it for their children, you always read, oh, give it away and survive for 7 years. 7 years is quite a long time. So, from a time perspective, investing in property eligible for 100% relief, much more attractive because you only have to hold it for 2 years as opposed to 7. The other advantage, of course, give it away, it's gone. You haven't got access to it anymore. Invest it may not be, hugely easy to realize your investment, but you have still got those assets. So an enormous number of people did invest in these shares primarily for the sake of the 100% relief that they were getting. There were some criticisms I've noticed last year, kind of quite a rising tide in the financial press about the fact that the returns that you got on these investments weren't necessarily great, partly because by definition they were smaller companies and therefore higher risk. Secondly, the investments were usually pretty fully priced in terms of the cost of buying the package. But, most people were doing it for the sake of the 100% inheritance tax relief so they could live with a less than stellar return on their investments. So we have lots and lots of people who have these investments. Well, slight surprise in the budget. The announcement was that the rate of relief on shares which are traded on non-recognized stock exchange, unrecognized stock exchanges but not listed, which includes the alternative investment market, the rate was going down to 50%. Wasn't immediately apparent at what point the rate was going to go down to 50%. And I think quite a lot of people were a bit uncertain. But it is now clear that like the other changes that are being introduced in relation to business property relief, the changes don't come in until 6th of April 2026. So if you die at the moment with a huge portfolio of AIM shares, you are still going to get 100% relief. But once we reach 6th of April, you are only going to get relief at the rate of 50%. Any property that you have apart from your AIM portfolio, which would be qualifying for 100% relief, that's completely separate. So your AIM investment portfolio, you can simply put in a box and it's going to get 50% relief. And I would imagine that most people will shrug their shoulders, feel a bit depressed, but go, well, getting 50% relief is better than not getting any relief at all. So I'm just going to leave my investments as they were. Okay.
Yeah, I mean, I had, a few grumblings afterwards, oh, it's not worth having them. But actually, when you do have that sensible chat with people that do have the holdings, well, 50% is better than nothing. And
Absolutely.
if you don't want to give it away, it's still a worthwhile investment. But, speak to your financial advisor, see what they're suggesting in light of the circumstances. But actually, for the people that have the substantial holdings, it's still a generous relief, just not as good as it was.
Nothing is. Nothing
Yeah.
is. Okay. Do you want to do one of yours?
Yes. So it kind of ties in, I think, with what we've already talked about, but does the complexity of a no ban discretionary trust justify the additional costs to a client? And again, I think it comes down to circumstances, what the client is trying to achieve, why the no ban discretionary trust is there, and then balancing that against the costs. Because trusts can be expensive to run, but they can also be run in a fairly efficient way, depending on what you've done with them. For example, the trust might just be a loan to a beneficiary and it will cut down on the administration. There's very little to do. And depending on the value of the trust, you might be able to avoid some of the reporting requirements. Sometimes the trust is there because there is a reason for having it there. There's the asset protection, whether it be a surviving spouse, one of the children. And yes, there might be costs involved, But actually, to potentially protect £325,000, it's a small price to pay. And it's a matter of having that discussion with the clients, looking at what they want to achieve, revisiting the situation once they've passed away, understanding where you are now, and then what will work best in the grand scheme of things. I've got a few matters I'm dealing with now where clients have passed away. There's no rate bound discretionary trusts in the estate. We have a chat about the options, but where there are lots of children, grandchildren, they see the best thing is just to wind up those trusts and divide the money. There's multiple beneficiaries, so they don't see the cost as being worthwhile. But I've got another matter where there is a slightly more vulnerable beneficiary. And actually, there's more risk in transferring a sum of money to that person because they're susceptible to financial abuse, squandering the money, not being able to manage, losing means tested benefits. So although there are going to be costs associated with it, they far outweigh the potential risks in just bringing the trust to an end. So yes, I think, as we've said before, the nil rate band discretionary trusts is such a valuable tool. Yes, we do need to consider costs. We need to be giving clients sensible advice, but look at the reason the trust is there. And quite often the trust is there for a valid reason. So the costs can be proportionate to the work that you're trying to do and achieve.
I'm just going to ask you a question now. One of the problems, of course, and one of the added costs, it's not a huge cost, but we have the trust register.
Yes.
And so we have to register trusts and we have to register details of the beneficial owners. And that can be quite annoying when you have a wide class of beneficiaries of the discretionary trust, because the revenue has changed what it used to say about this. So it used to say that if you had a class of beneficiaries, you only had to register their details if they were named, sort of my three grandchildren, X, Y, and Z, plus any other grandchildren that may arrive, that you'd have to register details of X, Y, and Z, or you would have to register details if one of those grandchildren actually got a payment from the discretionary trust. But you could refer to the rest of them by description. And then I can't now remember when they changed their advice, probably about 18 months ago, something like that. They didn't make a great deal of fuss about it. But what they now say in the trust registration manual is that they do expect you to give details of all of the beneficiaries, even if they are members of a class, unless it would be unreasonably difficult to do so. And the example that they give is of a trust, first of all, which refers to grandchildren of the settlor, where they say perfectly easy to put in the details, or descendants of the settlor, which frankly I think might be void for uncertainty, but it might not, I suppose. But anyway, with that one, they say if the trust was established many years ago, then it might indeed be unreasonable to have to register the details of all of the descendants. So one of the questions that I get, long-winded way round to asking you this question, but one of the questions I quite often get is it a good idea to have a very small number of named beneficiaries with power to add? The trustees are given power to add beneficiaries, and then you do a letter of wishes, which gives some indication of in what circumstances you would think it reasonable to add beneficiaries. Out of interest, what's your view on that?
So I like that option to have a small number named with power to add, because once you've started naming people in a will, the will is going to become a public document. People are going to know that they're named, even if they are there as the worst case scenario, the whole family's been wiped out. And they're going to ask for money. I think we've all had that situation where someone crawls out of the woodwork, notices they're named, and say, "Well, when do I get my money?" And they don't. But it just creates extra work for the trustees in dealing with that. Someone else to consider when they're considering how to exercise their discretion. So I prefer keeping the people named in the will or the trustee to the ones that these law want to benefit, but with the accompanying memorandum of wishes, which will set out, well, in this situation, this is who I would want you to add as a beneficiary, whether it's an individual or a charity, whoever. But I like to do it that way. And then nobody knows that they might be there as a backup.
Yes, I tend to agree. The trust registration manual does have this rather irritating bit where it suggests that even people mentioned in the letter of wishes,
Mm.
you might have to register their details. Personally, I'm not having any truck with that. I think that that is a completely beyond the point suggestion. But you didn't hear me say that really.
No, and I couldn't possibly comment that.
Exactly,
I think it's
exactly.
just a really silly suggestion that
Yes.
doesn't work in reality.
Yeah. Okay, let's take another one of mine. What happens if someone dies with several businesses eligible for 100% relief, which they leave to different people? Who gets the 100% relief? This question I got really early on, actually, and it was friend of a friend, where the person was a kind of, lifelong entrepreneur and had indeed set up a whole number of different businesses based, in fact, on his quite large farm. And they said, well, how is this going to work? And I think the answer is that it works in a pretty straightforward way, because what you do is you simply say, here's an estate, there's a whole load of property in it, which is eligible for 100% relief. We will add up and discover how much we've got. £1 million worth of it will attract relief at 100%, and the rest will only attract relief at 50%. You then work out your IHT bill on the whole estate and then apportion it. If necessary. It may not be necessary to apportion. If all the tax is coming out of the residue, for example, then you will simply work out your tax and pay it. If you had a situation where some of the gifts were subject to tax and some of the gifts were free of tax, you'd have a pretty unpleasant calculation to do, but you'd still be starting from the position, I've worked out my overall tax bill, and now all I have to do is apportion it across the various gifts. So again, a bit like the first question I had really, which is it's very similar to apportioning your nil rate band.
I think it's important then to be asking clients who benefits and to what extent, understanding the application of how that £1 million will be apportioned, because they might take different views. There might be different liquidity levels in different businesses that they've not thought about. I've had various clients over the years that have very valuable businesses, but there's not huge amounts of cash there.
Mm.
So funding an IHT liability is going to be a really big issue, but actually it's looking at the knock-on implication for the beneficiaries, and are they going to be in a position where they could look at, supplementing the annual payments that need to be made? What resources do they have in order to facilitate that? Is it going to work? Sorry, I keep not moving and the lights go
Now, God, you just said something then and it triggered. Oh,
I'm
yes.
sorry.
Oh, what did I want to say? Distracted by your lights going off. Um, oh, yeah. It's it's a wider thing, actually, that people come in and they've worked out that they want to benefit X, Y, and Z. Quite often they don't think about the IHT and where it's going to come from. So if they've worked out, for example, that they're going to give 100,000 to each of their nieces and nephews, and the residue is going to go to X, if it's an IHT paying estate, you really need to sit down with them and work out, well, okay, what's the burden of the IHT on these gifts going to be? If it comes out of residue, is X going to have anything approaching the amount that you thought they were going to have? And that sort of question is going to become, even more pressing once you're not getting 100% relief on, your business and your agricultural property.
Absolutely.
There's just one other mildly pleasing thing in the wretched consultation and the proposals, which is that at least the instalments of tax that you're paying are all going to be interest free, which slightly helps with the liquidity, but only very slightly.
They'll be interest free, but then I guess if the business doesn't have the cash there to support it, they're going to have to then look at a loan, or whether the company can actually continue because the liabilities are going to be so high. It's something that clients do need to be alive to and think about, and plan. And I think kind of, off the back of this, it's probably where we're going to see more policies being taken out in order to fund liabilities. And I read a really interesting article that, a lot of people see the money that you're paying for whole of life policies as just money down the toilet. But actually, think of it as a savings plan. That's money going
Mm.
aside, and you're going to get a payout at the end of it. But get the advice, speak to an insurance broker that knows what they're doing to actually know you're going to have a policy that's going to pay out at the end of the day.
I think that's really good advice, actually. One of the things that's been worrying me a little bit is that the alternative way of doing it, which would be to try and build up a cash reserve within your business, is that going to be regarded as accepted assets? Because you only get business property relief on assets which are needed for your business. And as soon as you've got something which is sitting there on the side, building up as an investment,
Yeah.
not required for the purposes of the business, but it's required to pay the tax, you do wonder what view the revenue is going to take of that. And I guess that the way I've thought of it, you may disagree, is if I was advising a client and they were saying, well, I am thinking of trying to build up a cash reserve, then it's probably a good idea to say, well, actually, what I'm really doing here is I've got two income streams, or two streams. One is what I need to run my trading business, and the other is this investment business that I'm running here, which is small and subsidiary. So I am mainly a
Yeah.
trading business, and I'm going to get business property relief on my two combined businesses. But I think people should just be a little bit alert to the problem of accepted assets.
Yeah, absolutely. It's an innocent step to take, to think I'll save up and have some cash in the bank, but it is those knock-on implications.
Yeah. Okay, should we do another one of yours?
Yes. Here we go. Hit the historic nil rate ban discretionary trusts that have been neglected. What
Ah, I
what
knew
what
there'd be one of
advice,
those.
what advice should I give a client who discovers a historic nil rate ban
Oh, I'm going
discretionary?
to listen to this with great interest.
Well, I better make sure I kind of come up with a sensible answer then. So, if the trust is there, it's in existence, you cannot ignore it, and ignoring it is probably the worst thing to do. The issue that I often find with estates I'm dealing with is, first spouse has died, the family have thought, well, everything goes to, surviving parent, we just transfer it over. But how do you identify what's actually in that trust? And I've seen it done in two ways, depending on the size and nature of the estate. One is we just kind of class it as a loan, that there is a debt against the estate of £325,000 or whatever the nil rate band was at the time the first spouse died. I've also seen it done where it's essentially an interest that's been acquired in the property because that's all there was at that time. The important thing is that the trustees deal with it and don't ignore its existence. You have the conversations with the clients as to whether that's going to continue or not, but also you look at what's there. First of all, it needs to be registered with TRS, and I recommend that clients do that as soon as possible. And we certainly won't act for any trusts until we know that trust has been registered. Once it's registered, we look at what reporting requirements we need to catch up on. And usually there's 1 or 2 10-year returns that need to be done, even if they are just nil returns. But if it's the value of the nil rate band or 80% of that value, there is still a requirement to complete and submit a return. So we'll catch up on that. If it's just a loan, we don't necessarily need to worry about income tax, capital gains tax, but don't just disregard all the taxes. Work through all of them, what fits the situation you're in, and then how best you explain this to the revenue. Then look at what you're going to actually do with that trust. Is there merit in keeping it going? You've got this far. Are there advantages to the family? Or is it a position now where it is just terminating the trust and appointing the funds out to the beneficiaries?
I'd agree with all of that.
I don't think I've missed anything. The biggest thing is just not to ignore it because that trust is there. And I will also have this discussion when clients come in to update their wills. They'll bring in their existing will. Quite often it's a pre-2007 will that's got the nil rate band discretionary trust. I can see that they were married. I'll ask about the spouse. I'll then ask about the estate. And sometimes that actually identifies that there is a nil rate band discretionary trust to be dealt with. So at that point, we can have that discussion. Well, it's there. What are we going to do about it? Do we put in place, a memorandum of understanding to say, this is what the trust assets comprise of? Do we get the trust registered? Is there any reporting requirements that we need to catch up on? Or actually a circumstances now just dictating perhaps it's just not needed. Let's just bring it to an end and we deal with it at that point. It's a lot trickier once the second spouse goes, when you've got that situation where the children haven't been involved. I've had a really interesting situation I've been dealing with recently where dad died, I think in 1997. Mother dealt with the estate. The will was quite simple, left everything to mother. Mother went off and got some advice to do a deed of variation to include a nil rate band discretionary trust. Mother died about 18 months ago. So the sons came in to see me. We've been dealing with the estate. They brought in a bundle of paperwork, and in it was a letter of advice suggesting a deed of variation to create a nil rate band discretionary trust. But they said they've been through everything. They cannot find any record that it has been done. The solicitors that mother had used at the time was no longer in business. No one has any files dating back to 1997. So they just said, well, we just have to assume that she never followed through on this advice. So we completed the IHT 400 on that basis. The property was then being sold. Whilst clearing out the property, they found a box of
Oh
papers
no!
with a deed of variation.
And they brought it into you.
They brought it back and said, well, what do we do? And I said, well, do you know what? We can sort this out. So we're kind of going through the exercise at the moment where we've registered the trust. We know that's there. We've had to do a corrective account for mother's estate because there's no transferable nil rate band. We're trying to identify the assets that went into the trust, but at the moment the numbers just aren't adding up. So please encourage your clients to keep detailed records and maybe let their children know what they've done, because this situation is just a bit of a disaster. Poor clients are ripping their hair out, but the important thing is that we're dealing with it because there were funds invested. So ultimately, if the revenue asks the right questions, they're going to identify that the trust is there.
I have occasionally had situations where it's a variant on what you've been talking about, where there was a nil rate band discretionary trust in the first will on the first death. Surviving spouse just took everything. Trustees, usually the surviving spouse and maybe one adult child or two adult children. And you can sometimes argue that actually what the trustees did was they decided to get rid of the trust on the first death and advance the assets out to the surviving spouse. So it is sometimes just worthwhile looking to see if there is anything to suggest that anybody gave any thought whatsoever, on the first death as to what should happen to this trust. Because you've generally got two powers in a trust. You've generally got a power of appointment of capital and income, which does usually have to be exercised by deed. So if you haven't got a deed, clearly nobody exercised that power. But then there's usually a second power, which can be exercised informally by the trustees agreeing that they are going to apply funds for the benefit of a particular beneficiary. So sometimes you can gather together sufficient information to suggest that that might have happened.
Yeah. Usually it's oh, well, there's a transferable no rate band, so we don't need it.
No, sorry, you used
Doesn't
it.
work like that. Yeah.
Okay, I'm just looking at the time. We've got a little bit of time left. I'll do one of mine. Um, is it right that property eligible for 100% relief settled on discretionary trusts before budget day pays no tax until its first anniversary after 6th of April 2026? So exits before that date are free of tax. Yes, that would appear to be the position. As I said, all we have at the moment is a consultation paper, but what the consultation paper says is that obviously we have this transitional period. For trusts which were set up before budget day, they do continue with the same rules, that the old rules, until the first 10-year anniversary occurring on or after 6th of April 2026. I'm sorry, I'm going to have to cough. Okay. Um, so what one might want to consider is it worthwhile appointing property out of the trust now if you were thinking of doing it anyway in the not too distant future, because you'll get the benefit of an unlimited 100% relief. You don't necessarily have to rush to do that, because if you wait until, and keep the funds settled, when you reach the first 10-year anniversary following 6th of April 2026, although you will only get £1 million worth of 100% relief at that point, you only get charged for the number of quarters which the property has been settled following 6th of April 2026. So if your first anniversary was, I don't know, April 2027, so you've got 4 quarters following 6th of April 2026, yes, you'll have an anniversary charge, but it will be extremely small because it will be limited to the period that the property was settled following 6th of April 2026. So for trustees, I mean, they are going to need some quite careful advice on how the transitional period works and whether or not it is worthwhile considering appointments earlier rather than later, and what are the consequences of keeping the property settled.
Sometimes I think it's useful to run hypothetical calculations,
Yeah.
and we'll do this now when we're looking at exit charges. Because sometimes the calculations come back and they're not as bad as people are anticipating. So clients are then able to make a more informed decision. Just need to have someone that's really good at doing those calculations. And thankfully, I've got a great team that can do that for me.
Yeah, I possibly should just mention, you may have property which is settled during the transitional period. So it's not a pre-existing trust. Someone has created a trust with property eligible for relief, let's say today. If property exits one of those trusts, if it exits before 6th of April 2026, it's the old rules, there's no charge. But if it exits 6th of April onwards, then that exit is immediately subject to the new rules. So there is a difference between pre-existing trusts and trusts created during the transitional period. If your trust is created during the transitional period, you don't wait until the first 10-year anniversary to become subject to the new rules. You're subject to the new rules as soon as 6th of April has passed. I may have to have a good cough. Do you want to do one of your
Shall I
questions?
take yes? I'm conscious of time, so let's see if I've got An interesting one. So something about preparing tax planning reports or estate planning reports for clients. So is a client's capacity an issue when preparing the reports? So in terms of preparing the reports, obviously we do need to think about whether the client has got capacity to instruct you. We can provide them with the advice, but then we then need to carefully think about what follow-up action they can take. Capacity fluctuates and it's decision specific. And there might be lots of things that we're advising a client on. So it might be gifting, might be transferring a property. It might be, creating a family investment company or setting up a trust. There's lots of advice that we can be giving to clients as to what might be beneficial in those circumstances. And if capacity is an issue, we need to consider whether they've got capacity to make the decision to take whatever action it is you're suggesting. And I think if you're concerned about capacity, then you need to get a capacity report and you need to give really clear and detailed guidance to the assessor as to how they should be reaching their decision and what factors need to be taken into consideration. So, for example, I had some clients I saw a couple of years ago. They'd had some advice previously. They'd sat on it for a little while. They then felt they're in a position to move forward. And there were various things that had been discussed. The property they lived in was in husband's sole name. They wanted to transfer it into joint names with his spouse. Husband had some rental properties and he wanted to gift some to his daughter. So we had the issue of gifting. But off the back of that, he needed to update his will, and in particular the memorandum of wishes, to accompany a discretionary trust to take into account that these gifts have been made to treat the other children equally. I think there was something else they wanted to do as well. And I wasn't entirely concerned about capacity. So I got in an assessor who works locally, really good at what he did, give him some really clear, detailed guidance. But what it came back with, in terms of transferring the property into joint names with his spouse, absolutely fine, a relatively simple transaction. He had the capacity to do that. We talked about gifting a couple of the rental properties, and it was a difficult one for the assessor to formulate an opinion on. What he was happy with was that he could understand the issues of gifting the property, what that would mean, but he didn't fully understand all of the implications. So he understood that he would give a property to his daughter, he wouldn't have that rental income, he wouldn't have that property. But what he couldn't understand was the taxation implications. It would have given rise to a CGT liability. And that's what he really struggled with. He couldn't understand that there was tax to pay as a result of making this gift. So he was deemed not to have that capacity. In terms of updating his will, it was assessed that he did have capacity to update his will to equalise treatment between his children, but actually that wasn't relevant because he couldn't make the gifts that he wanted. So when you are advising clients and you are concerned about capacity, do think about what needs to be taken into consideration for your clients and direct any assessor into talking through all of that with your clients before you then take any action. If they don't have capacity, then that's when you can have the discussions about whether you make an application to the Court of Protection. It's expensive. You really need to show that this is in the client's best interests, but actually it's a really worthwhile option to be taken if there is merit there and the estate planning can be justified.
I think that's a really good example of how capacity is not monolithic. You can have capacity to do something relatively straightforward, but you don't have capacity to do something that's more complicated. The other thing I'd say about the application to the Court of Protection is that would be quite a good application to make in your particular example, because one of the things that they always want to see is that they have to take into account the person's past and present wishes and feelings. And so if they have actually taken advice in the past and this is doing what they wanted to do, that's going to be quite a strong factor. But we've had several cases recently, haven't we, where the Court of Protection has gone out of its way to say that there are no presumptions. We don't presume that
Yeah.
people want to give things away. We don't presume that they want to save tax. We have to have evidence that, if this is what they actually wanted to do.
Yeah, because I do see clients where tax isn't the driving force behind what they're doing. And, I've had a couple of occasions where the clients have sat there and they said, well, what's my anticipated tax liability? And I'll do a little calculation. And they'll say, oh, so what will my children be left with? And I say, well, they're fine. So it's really important when you're having that discussion to actually understand what the driving force behind the decision is. Um, because for everyone, it's not tax. Tax is a factor, but it's not the driving force behind that decision.
Okay, I'm looking at the time very quickly. I only had two questions on my powers talk. One was, is deferring the right to income at 18 given by the Trustee Act 1925 to a later age a good thing? It's rather a difficult question to answer.
I,
It's triggered by the fact that the Step Standard Provisions third edition does defer the right to income where somebody has a gift which is contingent. Their right to income, if you don't do anything, they get a right to income at 18. You can defer that right to income, and the Step Standard Provisions is now deferring it to 25 as opposed to 21. And whether or not it's a good thing depends on what happens and, whether or not what it is that you're interested in. So the reasons why you might want to defer the right to income until 25 is that if someone has a right to income given to them in a will or within 2 years of the death, their right to income arises. So perhaps they have their 18th birthday a year after the death. If they then get, as a result of Section 31 of the Trustee Act, a right to income, they are deemed to have a qualifying interest in possession, an IPD. And so if they die between 18 and 25, that property is part of their IHD estate. Most people aren't too bothered about that. But the thing that you might be bothered about is that if you have an interest in possession, when you actually become entitled to the capital at 25, there's no holdover relief under Section 260 of the Taxation of Chargeable Gains Act. And that can mean quite a considerable charge to capital gains tax. So that is potentially a good reason for deferring the right to income, quite apart from the fact that if we're talking about a significant trust fund, you wouldn't necessarily want your 18-year-old to have access to funds, although there are ways round that. So looks like good idea. The counter argument is that if you're worried about residence nil rate band, which I strongly suspect fewer and fewer people will be concerned with because of the taper threshold of 2 million, particularly when pension pots are thrust into the IHT estate. But if we're interested about the residence nil rate band, if you leave property on trust, let's say I leave it for my grandchildren contingent on 25, you are only going to get the benefit of the residence nil rate band if your grandchildren take qualifying interests in possession, and deferring the right to income to 25 will prevent them having a qualifying interest in possession. Now, to my mind, that's not actually a big deal, because if you've got a trust contingent on reaching 25, then normally the trustees will have powers, and the trustees can give a right to income if it looks like a good idea. And provided they do it within 2 years of death, you get reading back. So the issue about the residence nil rate band, which may or may not be a live issue when the person dies, you can deal with it. So on balance, I'd probably say that deferring the right to income to 25 is a good idea, so long as the trustees have got the power to give a right to income if that turns out to be desirable because of the residence nil rate band. Do you want to?
I know I completely agree with everything that you said. It's just something that we need to be really alive to because these types of issues don't crop up all the time. It's really quite rare that you do have a situation where you've got a minor beneficiary. So it is remembering that there are all of these issues, and how to systematically work through everything to work out what's best in that situation.
Section 31 of the Trustee Act is something that people do really need to be alert to
Yeah.
because it applies unless you vary it, and it can have quite unexpected consequences.
I think the biggest things I remember from law school when looking at trusts, section 31 and section 32. And every time you got a trust, you think, right, what do they say?
Absolutely. It is 2 o'clock. Do you want to do one very, very quickly to finish off?
I can do a really quick one. Let's have a look. Right. Question. What should I do if I don't agree with action a client wants to take? And I guess this relates to you've prepared your estate planning report. Clients sometimes have ideas about what they want to do. You don't always agree with them. You can set out your reasons as to why you don't agree. So I will often do this in my report. Something will come up during a meeting, and quite often it's clients wanting to put their home into their children's name or something else. And I will say, we've talked about this. These are all the reasons as to why I don't recommend it. There are very limited circumstances where there is some merit to taking some action, but that's incredibly rare. And if the client comes back and says, well, that's what I want to do, then, I really do have to have a think about it. And if I can't stand by that action, I will tell them that I can't help. I did have one situation where I know that client went to another firm of solicitors who did transfer the property to someone else. But for my own sake, I can't stand by a client doing something that I really don't agree with if I can't see there's any benefit to it. It's not the right thing for the client. And most of us are private client practitioners because we care about our clients and wanting the best outcome for them. But also, we need to have the best outcome for ourselves. And what we don't want to find is that somebody is complaining, challenging us for action that we've taken when we shouldn't have done it. It's going to impact our insurance. It's going to be stress. It's just not what we want. So if you can't agree with it, then think about whether you can actually act, and don't be frightened of saying no. Especially when you think about the fees that are involved, quite often, you're not looking at tens of thousands of pounds to justify it. It's often a few £100s to complete a TR1 or do a deed of gift. And is that worth it? No, it's really not. Speak to, your manager, your supervisor. If you've got a compliance team, speak to your compliance team about how you handle it. But don't be frightened of saying no if it's not something that you can stand by and support.
Yeah, I totally agree. I mean, if you imagine the amount of trouble and trauma that's going to ensue, after somebody dies and their would-be beneficiaries come back and say, why on earth did you allow this to happen? Absolutely 100% not worth it. Okay, I think we have run out of time. So thank everybody who's been listening. If you'd like to submit a question for the next Shape the Debate, don't forget to sign up to receive emails from the solicitors group and be notified of future sessions. As Parisa said at the beginning, there is still time to book and watch the full pre-recorded content from this Law Online. The online event package is accessible for 90 days from the day of purchase and allows you to learn at a time and place convenient to you. You can book or find out more about this by going to the Solicitors Group website. And finally, don't forget to fill out your feedback form once you've completed your Law Online webinars. And as a result of completing it, you will receive your CPD certificate. So thank you for listening, and I think we both hope that it was helpful.
Thank you.